For more on our top line story, we're joined by Colin Cieszynski. He's Chief Market Strategist at SIA Wealth Management. Thanks, Colin, for coming in, and it's your first visit with us here in studio in quite some time.
It is. It's been almost 3 years, and it's really great to be back. I've missed it.
Your take on what we may see in the U.S. It looks like, I think it's reasonable to assume that the Republicans may regain control of the House. The Senate remains a coin toss, but as we saw in that report from ABC News in Washington, the Democrats picked up a key seat in the Senate in Pennsylvania, which helps their cause. Let's focus on the House then. Let's assume the Republicans get the House. What does that mean to U.S. politics, the policy agenda, and more importantly, to markets?
So for markets, let's start there. Historically, markets have liked gridlock. They've liked the idea that one party can't just go and push and do whatever they want. So, and it forces the parties to work together. It forces them to actually negotiate on legislation. And the markets have generally, historically, seen that as positive over the longer term. Although today we're seeing markets are down a little bit, but they've been up for 3 days as well. So, in terms of policy, there's a number of areas. It's certainly the energy is a key area. There's the Democrats are having more in favor of alternative energy. Republicans more in favor of traditional oil and gas. So we'll see probably a lot more of that playing out, as well as you had mentioned off the top, a lot of areas related to taxation of companies, of individuals, of buybacks, of a lot of areas. And markets historically have not liked higher taxes or anything that kind of can clog up the gears of finance or trading. So if that reduces the possibility of higher taxes, then the markets could over time potentially see that as somewhat neutral to favorable.
What about just straight up gridlock? One view that's out there is that markets tend to like gridlock because it provides some level of certainty as to the policy agenda. If less action from government is likely, that provides markets with some level of certainty.
In some ways, no news is good news, and that the less that things can come along that can kind of gum up the works or can cause significant change is usually frowned upon by the markets. So the markets do like steady eddy and some kind of, if not certainty, at least a general feeling on if nothing happens. That's often seen by investors as a good thing. And
there you see the latest count on the seats that have been won by the thus far by the Democrats. In blue, the bottom line is the House of Representatives line. The red line is the Republicans. 218 seats are needed to win control of the House of Representatives. And there you see the ultra-tight Senate race as well. Again, the Democrats in blue and the Republicans in red. What historically how have markets tended to react? They've been volatile post midterm elections, correct?
That's right. Historically, we've seen a lot of volatility in midterm election years, and midterm years have often coincided with major market highs and lows. In particular, we think of 1998. There was a lot of volatility. 2002, there was a lot of volatility. But what's been interesting is up until the last cycle, usually the markets tended to bottom out right around the election date, maybe a little bit before. But what's interesting this time is that 2018, the last midterm year, markets actually held up reasonably well until the election date, and then they fell off a cliff into the end of December. So the kind of the midterm of sell-off was delayed in 2018. So we've obviously had quite substantial declines in the markets this year. So we are likely around a seasonal turning point somewhere this fall. Historically, there has been, but whether we've passed the bottom or not remains to be seen.
One thing that some government watchers are speculating on in the U.S. is we may get another one of those government shutdowns where the two sides in Congress can't agree on a budget package and we get a temporary shutdown of the U.S. government, or those debates over the debt ceiling, which have almost the same effect. What's the market takeaway there from either one of those scenarios?
Historically, markets have sometimes come off a little bit ahead of while the negotiations are going on and ahead of a shutdown. But as we see, what happens often with strikes as well is usually any weakness or declines is usually front-ended. It's beforehand, and then by the time you actually get to the point of a shutdown or a strike, the markets often are looking ahead towards a resolution. So you can have some weakness, but it tends to be fairly short-term.
That's Colin Cieszynski.